For the equity method, there are 5 basic journal entries I want to talk about. The first journal entry is the journal entry investor makes when it makes the initial investment in the investee. And the journal entry here, the journal entry here is to debit investment account, credit cash, because investor pays out cash to get the equity stock from its investee. The second journal entry is when investee earns and reports income, and the journal entry investor makes at this time is to debit investment account, credit equity in investee income. So here, equity in investee income, this is an income statement account. And as we said before, investor is using its investment account to mirror the change in the shareholders' equity account of the investee. So when investee earns income, its shareholders' equity account would increase, and the investor would debit its investment account at this time. The third journal entry here is when investee declares dividend. The journal entry for the investor here is to debit dividend receivable credit investment account. So as we mentioned before, here investor is using its investment account to mirror the change in the shareholders' equity account of the investee. When investee declares dividend, its shareholders' equity account will decrease, and the investor will decrease its investment account at the same time. The fourth journal entry is the receipt of dividend. And the journal entry is the same as what we did under the fair value method, which is to debit cash, credit dividend receivable. And there's a fifth journal entry here, which is the amortization of excess payment. So let me first just clarify a little bit what is excess payment. And we're going to spend around 5 minutes talk more about this journal entry nature after our next example. But let me just clarify first what is excess payment. So when investor spends some money to acquire the equity stock in the investee, it is the money it paid, it is paying a purchase price. This is how much it paid. For example, it is paying $10 million to acquire maybe 20% of the stocks of one firm. So this $10 million is its purchase price. But if you look at the firm, it is acquiring the firm's equity stock. It is acquiring. It may only have a net book value of, for example, $4 million. So the difference between the purchase price and the net book value of the stock has acquired, this difference is called excess payment. And the rule under the equity method is if the firm is paying more than the net book value of the investee, this excess payment, if it can be identified, we need to identify those and to amortize those. So I'm going to talk more about this point later, but this is just what excess payment is. It's basically we need to amortize part or all of this excess payment. And the journal entry we make to make this amortization, it is to debit equity in investee income, credit investment account. So as you can see that this is exactly the opposite as the previous one when we record the net income earned by the investee. So those are the 5 basic journal entries under the equity method. And I'm first going to use an example to illustrate the first 4 journal entries. And then we're going to talk more about this 5th one. And then we're going to look at another example, which is associated with the 5th journal entry. So let's first look at this example when there's no excess payment. So in this example, you don't need to worry about the 5th journal entry. Let's look at the example. So company A purchased 40% of the stock of company B for $500,000 on January 1st and account for the investment using the equity method. The purchase price exactly equals the net book value of company B, which means that there's no excess payment. On December 31st, company B reported its year 2016 net income of $150. So company B reports net income now. what should company A do? Think about it. A company B paid dividend of 50,000. So company B paid dividend. What should company A do? Think about it as well. What is the balance of company A's investment account regarding company B at February 1st? So I'm going to give you 5 minutes, work on this example. You can pause your video for now and come back after 5 minutes after you finished working on the example. Okay, so let's now go over the solution of this example. What are the general entries? So first of all, company A purchased 40% of the stock of company B for 500,000. So the general entry is for on January 1st, that is the general entry for the initial investment, which is to debit investment account, credit cash for 500,000. And then company B report its year 2016 net income of 150,000 on December 31st. So when company B reports net income, company A's general entry is to debit investment account, credit equity in investee income, and company B report 150,000 net income. Company A has 40% of that. So 40% multiplied by 150,000, that is 60,000. So that is the net income. That is the income that should be recorded by company A. And then on February 1st, company B paid dividend of 50,000. So what is the general entry? Company B, from company A's perspective as an investor, it is receiving the dividend from company B. So it debit cash and a credited investment account. It is using its investment account to mirror the change in shareholders' equity account of company B. And then the total dividend paid out by company B is 50,000, and company A has 40% of that. So that is 20,000 for company A. So what is the balance of company A's investment account at February 1st? As you can see here, investment account begins with a balance of 500,000, and then it is increased by net income recognized by company A, company B's net income recognized by company A for 60,000, and it is decreased by dividend paid out by company B. So the ending balance for the investment account is 540,000. 500,000 plus 60 minus 20. So this is the example. And now let's look at the situation when there's excess payment. So this is regarding the fifth journal entry we just talked about. When there is excess payment, meaning that when the firm's purchase price of the equity stock is more than the net book value of those equity stocks, we need to allocate the excess payment to identifiable asset and liability. So in this situation, we need to identify which asset and liability may contribute to that excess payment. I'm going to use an example to illustrate more what I mean by this point later, but let's just like go over it first. So we need to identify the asset and liability that may contribute to this excess payment and to allocate the excess payment to those assets and liabilities. And then we need to amortize it over the remaining useful life of the respective asset. So after we have identified those assets and liability, we will know what are the respective useful life for each asset or liability, and then we will be able to allocate the excess payment to those and to amortize it over the remaining useful life of those assets and liability. And again, the general entry, we already talked about it. This is just the fifth general entry we just talked about. And then, so what if that part of the excess payment we cannot allocate to any identifiable asset or liability? And this part is called goodwill. We just call it goodwill. We don't know where it comes from, so we call it goodwill. There's no separate goodwill account. So this is different from what we are going to talk about later when we talk about consolidation. In consolidation, there is going to be a goodwill account. But under the equity method, we're not going to separately record, there's not going to be a goodwill account under the equity method. So we're not going to separately record any goodwill under the equity method. And so the whole investment is tested for permanent declines in value. Goodwill is not tested for impairment. So let me just use an example to illustrate more what do we mean by this excess payment stuff. So for example, ABC firm acquired 40% of PG Coffee for $10 million. And then, however, if you look at PG Coffee, what asset and liability you can identify? You try to identify every identifiable asset and liability PG Coffee has. So you may identify PG Coffee has a chair, it has coffee beans, it has machines, it has trademarks, those trademarks, trade names. All of those are going to have value. All of those are things you can identify of the firm. So anything you can identify, you need to identify those. And then you look at the net book value of everything you have identified. So for example, for PG Coffee, you identify the chair, coffee bean, coffee machine, trademarks. And then you try to calculate all of their net book value and you sum them up. That may only sum up to $15 million. So 40% of that is only $6 million. So what is happening here is you are paying, your purchase price is 10 million, but the net book value of the equity stock you purchased is only 6 million. And the difference between 10 million and 6 million, that is called excess payment. So the difference, the 4 million, that is the excess payment. And that 4 million needs to be amortized after acquisition. And then the question is, how much do we amortize for each period? So how do we do the amortization? How much do we amortize for each period? And then this question depends on the source of the difference between the purchase price and net book value and the remaining useful life of the associated asset. So what do we mean by this point? For example, PG Coffee may have a machine and the book value of the machine is 5 million. That is the book value. The fair value is 7 million. Okay, so you know now the company is paying more, maybe because it has a machine which has fair value more than the book value. So that is one source of the difference between the purchase price and the net book value of the equity stock. And then the firm may have a patent with the book value 2 million and fair value 3 million. So now you identified another source of this excess payment. The firm may be paying more because it thinks the firm has some asset which has a fair value higher than its book value. So let's just suppose those are the only two identifiable assets you can find. Those are the only two identifiable assets that has a difference between the fair value and book value. So those are the only two sources you can find here. And then so out of the 3 million difference, out of the 4 million difference, 3 million stream from the difference between fair value and book value of PG's identifiable asset, which is the machine and the patent. And then this difference can be amortized over the remaining useful life of the respective asset. So for example, the machine may have a remaining useful life of 10 years. So the difference, 2 million, can be amortized over the 10 years. And patent may have a remaining useful life of 5 years. This 1 million can be amortized over the remaining useful life of the patent, which is 5 years. So you first identify the source, and then you amortize the difference between fair and book value over the respective the useful life of that source. So however, here, so the difference between the purchase price and, so we have the purchase price and net book value. The difference between these two is called excess payment. We said that it needs to be amortized, but we can only amortize the amount we can identify and find the source. And here we can only find a difference of, so this difference in this example is 4 million, but here we can only find an identifiable difference of 3 million, which is coming from the difference between fair value and book value of the machine and of the patent. And then how about the remaining 1 million that we cannot identify? And this rest, the 1 million, which is unidentifiable, that is called goodwill. So if you still remember from your previous intermediate financial accounting class, goodwill is the only unidentifiable asset, intangible asset of the firm, right? So anything we cannot identify, we just put them together and we call it goodwill. That is what goodwill is. And goodwill, because we don't really know what it is, it cannot be identified. So of course we do not use it, we do not know the useful life of the goodwill. And so goodwill is not amortizable. We cannot amortize it. We just let it be. Here, so we just talked about, use this example to illustrate the fifth journal entry. And now let's look at an example here. Company A pays 125,000 for 30% of the outstanding shares of Company B. B's balance sheet report asset of 500,000 and liability of 300,000, which means that 500,000 minus 300,000, the net book value is 200,000. In calculating the purchase price from Company B's share, Company A determines that B's equipment is undervalued by 60,000. So part of the difference is coming from Company B's undervalued equipment. Company B's patent is undervalued by 400,000. So here's another difference, which coming from the patent. The equipment has the remaining useful life of 10 years. Patent has remaining useful life of 5 years. How much of the purchase price is allocated to goodwill? And what is the journal entry to record the amortization of the excess payment? So please take 5 minutes, work on this example on your own, and you can pause the video for now. So let's first look at the first question. How much of the purchase price is allocated to goodwill? So first, let's look at what is the purchase price the firm paid. Purchase price. Company A paid 150,000. That is the purchase price. And then out of this purchase price, what is the net book value of the equity stock it acquires? So the net book value of the firm is 200,000, and Company A acquired 30% of that. So the net book value of the equity stock the firm A acquired is 60,000. And then the difference between 125,000 and 60,000 is 65,000. And this difference is the excess payment. So the next step is to allocate this excess payment. How do we allocate this excess payment? We find that so there are two assets we can identify which has a difference between fair and book value that may contribute to this excess payment. And then one is the equipment. Equipment has a difference between fair and book value of 60,000. And 30% of that is 18,000. The other is patent. Patent has a difference between fair and book value of 40,000. And 30% of that is 12,000. So 18,000 plus 12,000, that is 30,000, which means that out of this 65,000, we can identify 30,000 of that we can identify and we can attribute it to the equipment and to the patent. And the remaining, so 65,000 minus 30,000 is 35,000. This remaining 35,000 that we cannot identify, that is called goodwill. So how much of the purchase price is allocated to goodwill? That is 35,000. And what is the journal entry to record the amortization of the excess payment? So we know that the journal entry is to debit equity in investee income, credit investment account. And then the question is how much, what is the amount we should put in this journal entry? So, which is also a question, how much do we amortize for each period? So the equipment, the two assets we need to amortize. One is the equipment, the other is the patent. For the equipment, the difference between fair and book value is 18,000. And then the remaining useful life of the equipment is 10 years. So it is amortized over 10 years. Each year, the amortization is 1.8 thousand. For the patent, the difference between fair and book value is 12,000, and it is amortized over 5 years. So each year, the amortization is 2.4 thousand. So 1.8 plus 2.4 thousand, that is 4.2 thousand. And this is the amortization for each period for the investor. So the amount we should put in this journal entry is 4.2 thousand. So you can, here is a more typed up solution, and then you can just look at it on your own.